There we go. Brian, are you back?
Yeah, I don't know what happened.
I don't either. You kind of went into the land of the lost. So
And now my sidebar is gone.
don't do that. All right, guys. So let's go ahead and get started. Welcome aboard. This is our RateMastery webinar for June 12th, 2013. This is Jason Helmer. Of course, joining me today, I have my gurus, Brian McNee. Brian, are you still with us?
I am, but I cannot see the presentation slides. I just have a blank screen. Hello, everybody.
Well, the good news is that I hold the presentation slides. So we'll see. I'm not quite sure what's going on with that. I don't know if you want to log back out, log back in. David Schurmeyer, are you with us?
I'm definitely with you.
Okay, what do you see, David?
What do I see on the screen?
Yeah.
Thank you for joining us. The webinar will begin shortly.
Okay.
I now see it. Apparently, David fixed it.
You know that's how it is. He likes to do that. So, oh, actually, and I know why. There we go. That might help too, because every time one of you guys talks, it bounces off to your picture, which wasn't there. So, and our chat box should be enabled, and you guys should be able to go ahead and post and comment on those. So, of course, again, joining me today, we've got Brian McNee and David Schurmeyer, and thank you guys for joining us. If you have any questions or comments, feel free to chat them in the chat box. Please keep it appropriate. Don't make any overly political comments. No Obama bashing or anything else. This isn't the forum for that. However, we're going to be discussing the mortgage market and interest rates and what's going on today. And feel free to chime in and ask questions about that for both Brian and David. Now, Brian, you had given me a couple of slides, so you'll have to tell me when you want me to pop those up on the screen, and I will do so. I do have those ready and willing. But for those that aren't familiar with our presentation today, what is RateMastery? Well, RateMastery is our way of giving back to the industry, and it is a premier educational program where we try to dissect what's going on in the markets and give you guys a lot of great feedback so that you have some heads up and can see what is going on. So I see our attendees are all in there, so that's good. Everyone is coming in, so everything is up and running properly. So with that said, I actually want to jump right into what's going on in the markets and why we see rates where they're at. And for that, let me go ahead and have you guys. Let me actually put up on the screen. I'll put up 1003 Magnet, and you guys can give us some information about that.
I would defer to the elder statesman who wins on both accounts, age and beauty.
We're going to go on reverse alphabetical order then. Go ahead, Schurmeyer. Tell me, why are we up 38 bips, and can we ride the rally?
Well, we've got some new news today. As everybody probably knows by now, there's a substantially increased fighting going on in Iraq. And just a few minutes ago, coming across the wire, we see a report from Iran that is indicating that they're about to attack any rebels that get within certain distance from their border. What's happened is that the rebels, the Islamists, have overrun most of the Iraq military, and it's shooting the crude oil up. And at the same time, we're getting a little bit of a bounce in the Treasury market, and therefore the mortgage market as a result of it. But that's the knee-jerk. That's a momentary thing. The bigger picture is, where are we in terms of the type of economic growth that seems to be expected by most everybody. And we've been writing about it now for the last 2 or 3 days, and we touched on it a few weeks ago that, in our view, the economy doesn't look very good, and we're expecting a huge sell-off in the stock market. I don't know when that huge sell-off will start. Maybe it started yesterday with the Dow down 102 points, but I doubt it, even though the Dow's down another 102 points as we speak. There just isn't any good news out there other than what you might pick up if you turn on CNBC and some of the other media that, by the very nature of what they do, tend to always want to look at the optimistic side of things, particularly the Wall Street folks. We're seeing downward revisions over the last year in terms of economic growth forecasts. The most recent one came yesterday from the World Bank. They downgraded their outlook for the economic growth on a global basis. In January, they projected a 3.2% GDP growth this year for the worldwide economy. They revised that down to 2.8%, 4/10%. I don't know what that percentage is off the top of my head, but that's a pretty big down revision for economic growth. In the United States, they cut their growth rate from 2.8% to 2.1%. Now, percentage, that's even bigger. The IMF has done the same thing. The Federal Reserve over the last year, every quarter when they come out with their estimates and forecasts for GDP growth, they've been ratcheted lower. The housing market, I don't see it to be that good, and you folks that are listening and so forth to this webinar have a better touch on that than I do, since you're the ones on the front line. And the job picture, no matter what you hear, no matter how good it looks when you look at the headlines, is not good. I think you know by now most of the jobs that we're seeing being created are low-income jobs that cannot fuel the economic growth that people are looking for when the pay that they get just isn't very substantial. Mix in with that the higher costs of insurance. The Affordable Care Act is raising insurance premiums for just about anybody that makes over $63,000 a year, at least for a couple. I think the more kids you have, the bigger the credits you might get. But insurance costs are going up. The only thing that I see as a bright spot are auto sales. Everybody in the world seems to be wanting to buy a car, but there's not a whole lot of first-time home buyers out there. It looks to us like the young people are loaded with a lot of debt coming out of college. And secondly, this historical thing that we've had in this country is broken a little bit right now in terms of home ownership being what everybody aspires for. All of that is going to put these interest rates lower. It may be a wild ride, but if we're right, when the stock market does actually come unwound, we should see some pretty good improvements. We're seeing it today a little bit. We have the 10-year note yield now sitting at 258. We went out yesterday at 264 on the 10, and a minute ago on the screen there were mortgage prices showing them up substantially from the 930 levels. Overall, we think at best the economy is just going to muddle along. At worst, it's going to explode into a variety of various unforeseen circumstances. Maybe this Iraq thing and the Iran thing, and we have the Russia-Ukraine thing. These unsettled things are popping up all over, and it certainly is going to shake the confidence of investors. So that's the way we see it at this point.
What about you, Brian?
Well, I think a lot of that is empirical. I think a lot of it short term makes sense. I think longer term, and I'm gonna use longer term as when it comes to a loan officer, it might be 60 days, but I'm gonna just say through the end of the year, we're gonna say longer term. I think that there's a tremendous opportunity for much higher interest rates than where we are right now. And I guess if you want to, Jason, if you want to flip to those 2 or 3 slides, I think that would be a good time. How do you like that Photoshop work, guys?
I'll tell you, you got a backup career right there.
Do not look at the bare private parts. But at any rate, yeah, here's Brian the bear.
You're bearing your soul.
Yes. Because it would make sense that I picked a female bear to put my face on. Really, what we want to do is I just want to hammer this this point home for you guys. And we do have a large and continued constant flight to quality, which is keeping treasuries and mortgage-backed securities afloat and at levels they otherwise would not be at. But there's something else that is going to happen, and it doesn't matter whether Ukraine blows up a few more, or Russia blows up a few more Ukrainian helicopters, or a few more grenades get lobbed in Iraq and Iran. This is going to happen regardless. And so let's focus on some things that we do know that we can count on. We know right now we're near the end of the second quarter, right? Or we just started, let's see, January, February, March, first quarter, April, May, and June.
Middle of it.
End of the second quarter. So right now, we know for a fact that the Federal Reserve is purchasing during this 3-month period. We have it broken down below for you. April, 25 billion, May, 20 billion, and June, 20 billion of agency mortgage-backed securities. And we know what the originations are. Part of that is stuff that's happened. Part of it is projections by the agencies. We know that we're about 24% of all the mortgage-backed securities that are being issued are being purchased by you, the taxpayer, right now. That's down from 42%. We also know reasonably high assurance levels here that just a month from now, when we start the third quarter, that will be cut more than half. It'll go from 24% to under 12%. Now, the purchases won't be cut in half, but as a percentage of the total originations, it'll be cut in half. We're going to be going to 35 billion. 15 billion in July, 10 billion in August, and 10 billion in September. And that may, there's a growing sentiment that that may be accelerated, but there's still a small contingency right now. So what you're looking at is supply versus demand here, which always sets price, even though we have it being hijacked by global geopolitical events and not economic events. If you have this demand, artificial demand, wane, which it will mathematically, then you have less support for pricing. And the question is, will the additional instability overseas make that up right now? I don't think so. And to look at the fourth quarter, we'll be purchasing with your tax dollars under 4% of all the Fannie and Freddie mortgage-backed securities out there. They have to find a home. And so in order to find a home, this is just simple supply and demand, folks. The price will go down and the yield will go up, and that's going to equal higher interest rates. That's factual. The only question there is, what is there to mitigate the impact it's going to have? And let's take a quick shot at the next chart. And that is going to be economic.
By the way, I can't see those charts. I don't know if anybody else can, but they're just on the little small part of the screen at the bottom.
Oh,
they're not showing up.
Well, I don't know. I had that issue when we first started, but right now they're really large on my screen right now. I can see them pretty well.
Well,
Keep going.
I don't know about the rest of the
Yeah.
I've got a an audience view up on my.
There I go. I can see them now.
Okay, there you go.
So right now, if we look at the first quarter, our GDP was negative. Okay, and this is just an illustration of how our market is hijacked. We have a negative GDP, yet mortgage pricing was at fantastic levels. Here, which is supposed to happen, the worse the economy is, the better bonds perform. Here you have, we're in the second quarter now, and GDP is projected, because we don't know yet, it hasn't been released yet, but because we're not finished with this quarter, but it's projected to be around 3%. Whether
Not
it's
going to happen.
8.75 or whatever, whatever it is, it's going to be at a significantly larger rate than what the first quarter was. Even if the GDP second quarter was just 1%, going from -1 to +1 is a big change. Yet during this quarter, when we're in positive GDP, it's just what level that we're in. We can't debate whether we're positive or negative. We're certainly positive. It's just what level. Even though we've had better GDP than the first quarter, that's supposed to pressure rates when the economy grows, whether it grows at a small pace or a fast pace. Its growth is growth. We've already hit the best rates of 2014. So what we're just trying to demonstrate there for you is that the market isn't operating on true fundamentals as we've known for some time. Part of the reason for that is the fact that whether GDP is -1 or +5, or whether the stock market is up 500 points or down 200 points, each and every week the Federal Reserve is buying mortgage-backed securities. So it doesn't really matter. They're buying it, they're buying it, they're buying it. So what I'm trying to demonstrate is when they stop buying and when they buy less and less, it will have a dramatic impact on pricing. And right now we're not really seeing the relationship. I know Schermeyer believes the stock market is due for a correction, and you know what? The bond market is due for a correction too. We have been trading at levels that just simply aren't supported, and both have been rallying for some time, and both can sell off for some time. And then after the Fed is out of the way, I think we'll start to have this relationship that they're supposed to have, where it's more of an inverse relationship. We've been making sure that during our commentary we've been pointing out, hey, look, they moved in the same direction today or the opposite direction. And it's not right. It's not right that stocks and bonds are moving in the same direction the majority of the time right now. And it won't be that way permanently. Once the Fed gets out of the way, that artificial buying of the bonds, whether they're up or down, will be removed, and they'll start operating the way that you're used to them operating. And that's when we'll have a real market again. And we're going to have it by the end of the year. But you can have a sell-off in the stock market right now and have a sell-off in the bond market right now. And so just because one's going one way doesn't mean that the other is going to go the other way right now. So if you could flip back a slide, Hammer, let me just beat this one issue home. We have Ukraine and Russia. We have China. No one's talking about this anymore. Their issue with, oh, geez, what country is that? Oh, geez.
Well, it's not important, but it's Vietnam.
Vietnam, there we go. Yeah, I kept wanting to say Taiwan, and I'm thinking in my head, no, not Taiwan. So, Vietnam, China, Russia, Ukraine, Iraq, Iran, and then pick up another, maybe something happens during the World Cup, and it's going to be Brazil versus whoever they lose to in the World Cup. There's conflict in there, and it's going to fuel a flight to safety. But we're seeing money fly not just in the treasuries now. We're seeing Spanish bond yields below United States Treasury yields. We're seeing Ireland's yields. We're seeing Portugal's yields looking good. We're seeing that other countries are having money flow into them. It's not just a pure safety play into the United States now. We just can't count on that. I think it's there. I think the global uncertainty will provide sort of a parachute for bonds. Bonds will sell off, but they're not going to sell off as much as they otherwise would have. I don't think that the global uncertainty and fear is enough to offset the Fed pulling out completely and keeping interest rates going in the direction that they're going in. So I guess that's really the juxtaposition I'm trying to present for you guys is the global world. We can assume there's some instability there. We're not really sure what it's going to be from month to month, but we do know the Fed is going to continue to pull back, and the market has to go through that, I don't know the right way to phrase it, Shermeyer. It's almost like a baptism. They've got to be dunked in the water and refreshed into a true open marketplace again, because we haven't had a true open marketplace before. And when they have that baptism and that moment of clarity, there's obviously gonna be some volatility at that point, and then we'll have a real marketplace again. I can't tell you how thrilled I am to have a real marketplace again at the end of the year, where we're not talking about the Federal Reserve, and we can finally focus on events that we can really sink our teeth into.
What's your take on that, David?
Well, I don't think that we're going to get away from talking about the Fed in any time in maybe even in my lifetime. They're sitting with $4.3 trillion on their balance sheet. The Fed and the central banks are walking on areas or are in areas doing things that has never been done before. We don't know how that's going to eventually play out, but my guess is it's not going to be pretty. As far as the interest rates are concerned, yeah, the Fed's pulling back, and they're not buying treasuries and they're not buying MBSs, but the volume of business is also slowing. So I don't think the impact of the Fed stopping their monthly purchases is going to have that much direct effect. I think most of the effect that we're going to have to deal with, and I'm not saying, I'm not arguing with Brian in the sense that interest rates. What?
Hammer, could you jump back down to that Fed slide?
I haven't seen those slides on my screen all day. It comes up and then it goes away.
They're elusive, those damn slides.
Well, as I was saying, it's hard to see from our perspective, Sigma Research, and my perspective, that this economy, no matter how you cut it, has much chance to show any substantial growth. And as a consequence of it, I think there's going to be more than just a correction in the stock market. I don't know when. I mean, it could be 2 years from now. It could be a year from now, or it could be next month. I'm not that capable to predict when it's all going to roll over, but the data continues to show that it's not as good as what the markets continually anticipate moving forward. Certainly there are some economic reports that come out a little bit better or better than what the markets were expecting and so on, but let's take it down the line. Weekly job growth looks good if you just look at 200,000 in that area, but when you look at where those jobs are and the income that is derived from that, the economy just cannot grow. You look at what's going on with people that may or may not know more than I do, or Brian, or any of us. The IMF, the World Bank, our own Federal Reserve. This has been continually going on now for over a year, close to a year, maybe a little bit longer, where every quarter when they come out with their estimates for economic growth, they've been revised lower. What happens in the second quarter certainly is going to be better than the first quarter, but if the people at the World Bank have any brains, and I'm not sure they do or don't, but if they think that at this moment anyway, that the growth in the United States this year will be 2.1%, it's hard to see where we've already got one quarter that is showing a negative 1%, although I don't think we've gotten the final on that, have we, Brian? I think that comes out at the end of this month or shortly. But let's say it does come out and it's finaled at minus 1%, and you get a 2% growth in the second quarter. Well, it's going to be damn hard to justify a 3% growth by the end of the year. Now, things change. There isn't any doubt about it. And as far as what a normal market is, yeah, these aren't normal times compared to my times anyway, and Brian's, and particularly guys like me that are a little long in the tooth. We've never seen markets like this. But nevertheless, it is what it is, and it is the market. How it all plays out, we just have to, what I'm talking about, and I think Brian to some extent here too, talking about what we might see longer term. What we have to do is take what we think we know and continually mash it up in our minds and make the adjustments when we have to make the adjustments. Right now, I think interest rates are going to come down here a little bit. They may be at 3% by the end of the year, but uh, I'm looking for these things to retest the lows at 240. Now, uh, that's our opinion, and it's all it is. It's an opinion based on the way we see things. And obviously, in a sense, I'm the Lone Ranger out there. More people think more along the lines of Brian than myself. So, that's what makes a market. A whole lot of different opinions mashed together to come up with some directional movement, whether it's stocks, bonds, crude oil. By the way, crude oil is going through the roof right now.
Yeah, it is. And crude oil has got an interesting play on how it impacts our pricing historically. You've got kind of that period where as it rises, people look at it and say, that's inflationary, and bonds don't like inflationary. And then it rises so much that people look at it and say, now it's a drag on the economy, and therefore there isn't as much inflation because the economy isn't growing as fast. So it's interesting how oil can impact things both ways depending on how much it shoots up. And right now we're in that phase of it's providing, input costs, higher oil price as an input cost is inflationary, and that's something we got to watch out for.
Well, the OPEC people, from what I read, I think in the Wall Street today or somewhere of all the stuff I read, they're not thinking that they're going to have to produce more oil because of this Iraq thing going on. That's what's driving it higher at the moment, because of the non-OPEC countries' ability to produce more oil than they've been able to produce in the past, like our oil production here in the country. So yeah, but I agree with Brian. It has a tendency to be looked at both ways. However, if it stays high and the gasoline prices stay high, that's just another kick in the butt for the lower income folks, which this country is becoming more and more involved in. The haves and the have-nots, the income inequality, I don't think there's anybody on this webinar that doesn't see that. And what do you do about it? I don't know what you do about it, but it's there, and it does have and will have an impact on growth. Now, when, how, or whatever, and we could rejoin this in 6 months and have a report card, I suppose. But Brian's got some valid points, and I believe I have some valid points.
And thank you, Dave. I think really the one takeaway that I want everybody to have from here, because we do these on a regular basis, and really we look at what sort of the topic du jour is and how it's impacting the pricing for that particular period of time. And there's been so many times we've talked about, well, here's what's going on in Ukraine and Russia, and here's what's going on. This is what's really driving pricing. But the market, if you think the market has baked this in, the market has not baked this in, what you're looking at right now. This is, I don't know what kind of pie chart to put up, but the economy, and whether it's at 1% growth or 5% growth, is going to be one pie wedge that impacts your pricing. The stock market's going to be a wedge. Global instability is going to be a wedge. But also a big wedge is right now the fact that people are buying mortgage-backed securities that otherwise wouldn't purchase them. And those originations are not going to significantly drop. The Mortgage Bankers Association for the third and fourth quarter has some pretty decent numbers up there on the last slide. And even if you water those numbers down, the fact is that the Federal Reserve, whether they're purchasing 40% of all mortgage-backed securities in the first quarter, and whether that comes out to 24% or 20% in the second quarter, and whether it comes out to 12% or 15% in the third quarter, these are significant moves that are not accounted for in the marketplace because they're still buying billions of dollars every month. This is something you need to be prepared for. Yes, If we have weaker GDP in the third quarter than everyone expects, it's going to help your pricing improve in that micro spot that you're looking at. But it'll improve over where it was. We're going to have a shift down in mortgage-backed securities. We're going to have a shift down. It doesn't matter whether a stock market is selling off or moving. We're going to have a shift down because the demand side is going to be altered. This is just simple economics. They have to understand the demand side is going to be altered. Somebody who is buying a boatload of mortgage-backed securities is not going to buy them anymore, and it's going to really impact your pricing in the fourth quarter. And I think that's the takeaway that I want you to have. Yes, if there's an implosion and something happens and we go to war somewhere, that's really going to help pricing, unfortunately. But it's going to help pricing down up from a level that's already been lowered due to the fact that this player is gone. Take that chart that we put together for you and look at it and show your realtors and show your clients and just understand mortgage rates are going to go up in the third and fourth quarter. The other events, such as the economy, what's going on with oil, what's going on, will mitigate just how far they go up, but they're going to go up. So.
Well, then another way to say this that it's my hammering point, and I don't mean that's but I've preached it for 25 years, and it was a hard sell when we were selling up against Mortgage Market Guide and Barry Habib and various other people who made a big effort to try to isolate the mortgage-backed security market from the Treasury market. If you're going to see higher mortgage rates at the end of the year, you're going to see higher Treasury rates. It's simple as that. It's the Treasury market that's leading the mortgage market, regardless of the specific fundamentals and the margin difference between the two as they both go up or down. So to build a case for lower mortgage rates, it has to be built on the back of the belief that Treasury rates are going to go higher, and I don't doubt that. I'm
Treasury rates projecting closer
but
to 8% on the fourth quarter.
But we got to deal with the markets the way they are right now, and at least as far out as we can try to anticipate with any degree of confidence. And these various things, I keep coming back to it. We're seeing the IMF, the Federal Reserve, the bank, the World Bank, the chaos that is coming from the European Central Bank. Mario Draghi, the head of the central bank, is almost in a panic mode. They're real close to dropping into a deflationary economy. All of these factors are going to have an impact, whether, the Fed cutting back on their purchases and so on and so forth. But if we're going to see higher mortgage rates, that means we're going to see higher Treasury rates. And if we're going to do that with any great increase in rates, it's probably going to have to be built on strong economic growth. And that is what we just really don't see right now. So
yeah, we have moderate economic growth.
Yeah, I think it's moderate if you just look at the headlines. I think if you look at the guts of it and what's really going on behind the scenes, that it's mediocre growth at best. But how about any questions from all of the folks that are on this? You and I are going back and forth with our opinions, but let's hear what somebody else wants.
You should be able to see the chat box, and
I don't see any. I just see a bunch of names. I don't see anybody asking anything.
Yeah, most of the chats I see, Hammer, are I don't see anything on my page. I see it. I'm using Chrome. I don't see it. I'm using Explorer.
Yeah,
it's great for me. I can't see anything. It looks like most of it. I'm out wasting my time. Nothing on my end. Nothing here. I'm seeing a lot of.
I'll read you some of them. Here you go. We don't need to read all of them. So there were some questions about the manipulation of oil, and are there a few entities that are manipulating the market?
How? I
Well,
mean,
I guess because of with you said with oil prices going up.
well, oil is a very volatile commodity. It always has been, and it can exhibit some rather dramatic changes or movements that a lot of times don't stick. It's not a trader's it's a trader's heaven. It's not a, even though we're looking at $105 crude right now or thereabouts, doesn't mean that that's going to last more than a week. We saw it hit $103. Oh, I bet 6 or 8 months ago. Then it was all the way back to $92 for no particular fundamental reason that you could sink your teeth into. Not like we blew up a bunch of oil fields or anything.
Yeah, maybe it's the fact that it's similar to the Chinese copper situation where they're they're using it as collateral for a loan and then they're finding out the copper doesn't exist.
Well, the world exists by energy, and you get a lot of traders,
Here we
making
go.
strange decisions.
Couple good questions. One that sounds a little off at first until you actually think about it. Would the results of the World Cup have any influence on interest rates?
Well, they're looking pretty serious about some of the security issues over there, but I doubt it unless something major league develops. But I don't think, if I were a trader, I would be buying security or treasury bonds, for example, or 10-year notes or whatever, on the theory that something bad is going to develop over there.
Right. What about Brian? We'll let you bounce this one. Any thoughts on the convergence of the jumbo and conforming rates?
Well, the jumbo rates is more of an open marketplace than the conventional rates are, because the conventional rates are bastardized by the fact that there's this artificial demand purchasing the underlying bonds. The jumbo rates are more of an open market situation because they're outside of the Fannie Freddie parameters in most part, and I'm seeing more of the banks getting in and playing in that market, and that's creating competition, and I think that's good. I think that's good for jumbo rates.
Jumbo rates are coming down more than the 30-year, the conventional fixed, aren't they?
Yeah, well, that's because we've got some people entering the market, and it's creating competition for that. So,
so now there's 4 people instead of 2, huh?
Well, you got more people lending than say there were a couple years ago, and starting to recognize that you got a nice, attractive product. They no longer believe that a $1 million home is going to instantly be worth $750,000 because property values are constantly sliding. So you've got some belief there that the underlying asset, the residential property, isn't going to erode. You've got good credit and good solid income and underwriting, and you've got banks interested in that product.
All right. Well, we're a bit over time, so let's end on a strong note. Let's kind of hit on you guys individually. I'll let you guys decide who's going to go first. But looking at the Japanese candlestick chart, we peaked, as Brian had on his slides, up on May 27th. Or May 28th rather, and we've had quite a slide since then. Yesterday it seemed like we were going to get a bounce, and then we closed 3 basis points above where we started. But today we seem to have rocketed up. Does this signal that we might, is this a short-term bounce, like when we look at the patterns where we get 2 or 3 good days and then we're going to go back down again? Or do you guys think that we might be able to see something that bounces us past those May 28th levels?
I do not see us bouncing past those May 28th levels. There is no appetite. You can see the wicks up there. People don't want to own the mortgage-backed security at those levels. I do think we found a 50-day moving average, and it's going to provide us with some temporary support. I don't think you're going to get hurt in pricing over the next couple days. But next week when the Federal Reserve comes out and they announce their tapering, we're going to all be paying very close attention to the potential language change that could give us an idea on the timing of their Fed rate hike. And starting to sense that the market pushed that out from June 2015 to all the way to the end of 2015 and maybe even to 2016. And I'm not so sure that it's going to be that far out, but I don't think it's going to be as near as June either of next year. So it's really going to depend on how the market feels that language is pointing. I would love to get a surprise announcement that they're just done with QE, but we won't get that. So I think we found a temporary bottom, but I don't think we have a full-blown trend reversal yet.
Okay. What about you, David?
Well, I do all my analysis work on the treasury markets simply because they drive the mortgage market. We tested pretty close to the 100-day moving average on the 10-year note yesterday, and again here this morning at the open. I like the market. I think that there's a really good chance that we can get back down to the lows that we saw in the latter part of May, down around the roughly the 240 level. And I predicate that on because I believe the stock market is going to lose a little bit of its flavor. It may not be the time for the kind of thing that I think is going to happen eventually, but it's enough to spread the risk around. And Treasury returns on treasuries this year have been quite good. I think it averages around 3%, which isn't a bad rate of return if you're a huge player or a huge investor or even a business in the markets that wants to balance out a portfolio that up to this point has been heavily loaded in equities to keep the equities going and at the same time buy a little bit of treasuries and back off the equities a little bit. So bottom line, I think there's a better chance to hit the 240 level right now than it is to get the 10-year note up to, let's say, 270 or 280. You know, that's today, you know. Next Tuesday, I might have something else in my mind.
Well, there you go. All right, guys. Well, thanks again for joining us this week. Thank you for sharing your opinions. I also appreciate when they are different. I did notice one comment of someone said, well, you know, they're covering both sides of the fence or something similar to that. And, you know, well, that have you ever seen, you know, talk radio, CNBC, MSNBC, whatever, Fox, whatever, you know, if either one of these guys had a crystal ball, they wouldn't be on with us. They'd be on their private island, like Richard Branson. But in the meantime, you know, I love to hear the different opinions, and sometimes one is right, sometimes the other, and both of them will make you think. That's the benefit there. So thanks again for joining us.
Whoever made that comment should understand that that's what makes markets, differences of opinion. If everybody thought the same thing about, say, the bond market at every given point in time, there would be no market.
You know, well, and they should know one more thing. No matter what Brian says, no matter what David says, my wife is always right. So, I mean, and you know, as long as we've got it down pat, we know who's who. That's all that matters.
Have a good afternoon, folks.
Brian, take care.
Everybody, take care.
Bye-bye.